investing for a balance of tax efficiency, meaning that, like, for example, if you're investing into a real estate deal with cost segregation and large depreciation, you can offset those passive losses by, most investors can, investing into a medical fund like ours, because those oftentimes passive investors, depending upon their situation, can take income in the medical industry, those passive income in another, and offset it by losses in another, passive losses in another. And so those kinds of tax efficiencies allow for you to have stability and non-correlation without being all in one volatile thing, right? And it's important to have some lower risk income things that are not for huge risky growth. And it's important also to look at some things that may help offset your income, but very measured. Like, some people like to really get big in oil and gas.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show, or watching, if that's what you're doing, on one of the audio and video recordings on YouTube and Facebook and LinkedIn and everywhere else. We're glad to have you on the show. So in any case, we've got a great guest today, Patrick Grimes, and he's got a very interesting background, and what he's doing in today's world, how he shows up, is also very unique and interesting. So I think you're going to thoroughly enjoy today's show. If you're driving, don't worry about notes. We'll put everything in the show notes for you. If you're not driving, I do recommend you take notes. So in any case, first of all, Patrick, I really appreciate you being here. I mean, I've read about you, and I've been looking forward to this. So I'm very grateful that you're sharing your time and energy with all of our followers.
Glad to be here, Gary, and looking forward to having a fun conversation with you today.
Great. Well, I am too. So let's start at the beginning. Everybody's always curious about, how did you get to where you are? So if you wouldn't mind, maybe share like an early on inflection point, something that happened in a prior job or while you were in university, maybe something your grandfather told you, and it was an inflection point for you that got you down this path that you're on,
Sure. Well, I mean, I started as a mechanical engineer, and I was actually doing fairly well back in those days. I mean, I didn't think I was ever going to do anything different, but I got some advice to go invest in alternatives from the founder of a company I work for, and more so real estate. And I kind of got a little over exuberant. I mean, he said his only regret was not investing more sooner. I didn't know how to do it more sustainably back then. And so what happened was, I invested in a real estate development that went south in 2009 during the subprime mortgage collapse, and lost everything. But I failed quick, but I learned a lot through that time, and more about resilience, and also about investing and diversifying, and kind of set the stage for failing early, and failing soon. Set the stage for me kind of building the diversified portfolio I have now.
Okay, so you're gathering, obviously you have not just invested in real estate. You have other sectors and categories to invest in, and one of them that I thought would be interesting to tap into, because it's one we haven't really covered on the podcast before, is diversifying into litigation investments. If you wouldn't mind expand on that a little bit. It's got resilient returns, stable growth, and of course, as soon as you say the word litigation, people's radars go up, because it's sometimes can be a negative or a positive, but kind of take us down that road a little bit and expand on that a little bit, if you don't mind.
Well, you're talking to somebody that got really into high tech. That was what I was doing as an automation robotic engineer, and that went for a ride. And I diversified into real estate. Well, that went for a ride too, in residential during the subprime mortgage collapse. And in 2022, we saw a major reset in apartment buildings, right, with the forbearance of evictions and skyrocketing interest rates and increasing payroll costs and everything else. There's no one ticket that can get you to a resilient portfolio that could outlive time. You can't just be all in, and can't be a one thing guy. And I learned that really early. So being from Hawaii, I don't from here, but living here, I like to say I like to spearfish my investments, because I like to be hyper focused. And when I look at, hey, where should I put my next dollar? I'm looking at, okay, what is really the Venn diagram of what is recession resilient? Because I've had my fair share of losses, and I just recently came off for some really tough times in apartment buildings, and I'd like to invest in something that's resilient over time. That means better markets that are more resilient, asset classes that are resilient. And I like to invest in things that are non-correlated, meaning what is my portfolio now? What are the market fundamentals? And if one thing shifts, like interest rates, like does my entire portfolio go for a ride? If the stock market collapses, my entire portfolio, what are other industries I can invest in? So you think about, well, litigation, that's scary. Well, actually, really what we're talking about is the legal industry. And really, if you want to invest in industries which don't rise and fall together, you got to look outside of kind of the more popular, well-known real estate, stock market, oil and gas, kind of think of these things that are really common, but also very volatile. Other industries that just simply don't have that volatility and are less known, less common, which actually means they have oftentimes higher returns because they're less efficient, they call it. Our medical, our legal, our HVAC, plumbers, these things that don't tend to care what's going on elsewhere, right? They just tend to be up and to the right. And that's why I chose the legal industry.
Nice. Well, I'll tell you what, if without sharing, of course, specific facts like names and places and things like that, can you give an example of like, let's say somebody listens to the show and they're a dentist, they're very busy, they already run a practice, they've already got investments, and this sounds interesting to them. What, or like a case study? That's what they look for. Hey, give me a case study. Show me, John Doe comes in, says I'm interested in this. Patrick, what do I do? How do I get started? What does it look like? What's your role? What's my role? If you don't mind, I know that sounds like a big loaded question, but that's the kind of stuff that people will really want to. That's what they want to know. I mean, they're thinking already, I might want to do this, when they hear this podcast. So yeah.
First, I'm not a financial advisor, an attorney, or a CPA, so I don't give financial, accounting, or legal advice. But I do full time now invest in what we call alternatives, and we educate on them on our website. We have a bi-weekly series where we just talk about every different kind. So the first thing I tell people is go get educated. We're one of the very few places you can go, and every single 2 weeks, in fact, another hour and a half from now, we're going to be doing one on investing in the flex space industry. And we're going to talk about what we've done on timberland, gold mining, cannabis. We talked about all kinds of different things. I'm not doing all of these, but it's important for us to get educated on not just the 50 stocks and startups and cryptocurrencies, but the 50 kind of alts that don't all rely on the same market fundamentals, that build true resilience and pillars that are more stable. And so that's what first say is like, join our series or join other ones, join podcasts, join investing events, begin to get yourself exposed to this world of alts. And unfortunately, if the financial IQ of America is not very high in this space, in fact, we're pretty much conditioned to just put everything into your 401k account. But anyways, and then I say, when people set up a call with me, typically they resonate a little bit with the sense of uncertainty, because the uncertainty is, man, there was a black swan event, interest rates are rising, inflation is looming, there's wars going on. There's all these things that create uncertainty in the global markets, more so than a lot of years later. And the thing is that if you're living with that uncertainty, then it's as a result of something, and maybe it's because you've staked your life savings and all of your wealth onto an investment portfolio that is teetering over just a couple fundamental factors. You have drivers that you have no control over. And traditionally investors I get that. So the question is, well, if you have your pie chart, where can you invest elsewhere that don't rely on those same market fundamentals? And so we happen to also offer alts as a company that I like. We offer them in real estate, equity, debt, and legal and medical, because I feel like those are really great allocations. We also educate on every other version out there. And so that's kind of what the conversations are like.
Yeah. Well, I appreciate that too. Now, you just mentioned a couple different categories like medical. So how generally, or even if you can even, dig deeper on it too, how do litigation investments align with the concept of diversification? What role do you play in building a recession resilient portfolio? Because everybody now is, well, it's everybody, half the world's thinks we're in good shape. Our U.S. economy, for example, can take a pounding and keep on going. And other people are like, no, we're headed right down the drain pipe. So so they're looking for recession resilient portfolios. But back to the main thrust of the question is, we want to expand more on the diversification part of it, if you don't mind.
Yeah. Well, I mean, if you look at all of our slide decks kind of show like here's real estate and here's US dollar, here's gold, here's oil and gas, here's the stock market. And you can see they just all kind of go for a wild ride over the last several decades. Whereas the fundamentals behind medical and legal are just up and to the right. They tend to just be needed. I mean, healthcare, whether or not people need healthcare, isn't truly affected by interest rates, right? Is it truly affected by the state of the economy?
Mm-hmm.
And also in the legal industry, turns out that people need representation when times are really good, and when times are really bad, people need representation. And the fundamentals even behind that in the legal industry are that people still pay their bills, they pay their attorneys, and attorneys still bill the hours. It's just been more steady growth. So when you look at those industries, you're saying, hey, look, I'd love to make an investment in those. It's not as easy to do. That's why they're lesser known. That's why they're less efficient. And that's why you can get higher, what we call risk-adjusted returns, higher return at a lower risk than you can in the stock market or even in real estate, because there's thousands of people vying for the same real estate deals for every one person investing in an attorney or investing in medical practice. And so you just look to solve a need in those industries. And just like how we lend to real estate operators that want to acquire properties and improve properties, and we get a lien against the asset, and we provide a conservative finance amount to the value of the collateral.
This is good stuff. I really appreciate you sharing this, because what you just shared, actually, what that does is help people understand how those factors contribute to the stability and growth potential, when it comes to investing in litigation finance, and we really how they perform independently from the traditional market. So let's talk about that a little bit. How can you explain the importance of the non-correlated investments and how they protect wealth during economic downturns? Sort of a follow-up question we were just talking about.
Yeah. Well, fundamentally, any investment you're going to make is relying on some kind of valuation, whether it's the value of a building and you're either buying it as an equity owner and you lose every penny or you gain every penny as the valuation goes up or down, or you're a debt holder and we're lending like we are in a lending fund. Same thing with lending into or financing medical practices. You have the value of their collateral, their assets, in our case, their medical receivables, the care that they've given, and their IOUs that they're owed from these large insurance companies will collateralize those. And then in legal, it's contingency fee-based attorneys that have these agreements saying they're going to get paid when a settlement comes in, and they have a value. And so basically look at okay, what controls those values? And in stock market, it's just the sentiment driven ups and downs. And so everything trends together. And in real estate, you've got good trends of sentiment, which affect people's desire to want to buy or not buy. You also have interest rates and gap rates, right, that drive those all together. But then the value of medical claims, these large Blue Cross Blue Shield insurance companies that owe primary care providers or medical practices, that there's just a delay in payment, right? That does not affected by those market drivers. And same thing with attorneys. Somebody was injured, somebody's hurt, and it's an established law type case or part of a large, what we call mass tort. Whether or not the economy is going up and down, the exposure and the case law and the liability and the causality, those primary factors which affect how much the award or judgment is going to be, those don't rise and fall with any of those other broader factors that might affect a medical practice or a real estate or the stock market. And so you look at, are the valuations going to be stable regardless? And so you kind of feel just like how people might say, hey, you should buy some cash because when the dollar goes down, buy some gold because when the dollar goes down, gold goes up, right? There's an inverse correlation. You can also invest in legal or medical because when everything else goes up or down, they don't care. They just don't care. The underlying fundamentals of the industries are non-correlated.
Yeah. Okay. I want to kind of branch off to some other categories, but I don't want to necessarily leave this one quickly. So if the listeners have the opportunity, kind to participate with you or other funds? Like, is an actual diversified litigation portfolio that people can invest in, or like, you know, recessionary acquisitions and income funds that they can invest in directly, either through, there's probably some SEC rules, I'm sure. So I'm not sure if they have to be accredited investors, for example, or can they just go on to, like Fidelity and Vanguard and find these types of funds? Are they out there open to the public, or is it really um, people have to approach you directly for these, and they have to be accredited investors? How does that part of it work?
Hmm. Yeah, well, we are with the two sides. One side is we just educate, kind of bluish an approach on everything, all the kind of alts out there, and that's our biweekly mastery series. And we just had a summit with over 40 speakers and over 700 people attend live, which was awesome. But on the other side, where we actually sponsor investments, we practice what we preach. We do have 3 open funds. Our acquisitions fund, where we're acquiring commercial real estate, that's full. But we do have accredited investor opportunities, which allow for investments into a debt portfolio. It's a portfolio of loans into commercial real estate. We have opportunities in a litigation finance fund, which is our diversified litigation portfolio, and opportunities in a medical receivables fund, which is, financing medical practices. And so really those kind of give that ability to carve out slices of your pie into some of these other markets and build more stability.
Okay. All right. I think that helps. Sir. What I want to do now is, when I was reading and gathering information, one of the things I saw was beating the tax game, exploring investments that maximize tax efficiency and growth potential. Can you unravel that a little bit for people? And I do want to save a few minutes at the end to go back to real estate, which was where most people are starting. But what are some of the things that people can do to maximize tax efficiency right now and growth potential?
Well, I think everybody's situation is a little bit different. And I think that there's really like 5 pillars of our company. One is just learning about alts. One is learning about non-correlated resilience. One is about networking. We provide networking opportunities for people to build their tribe. But all of those, the foundation of anybody's portfolio is really in 2 things. It's in building a portfolio safely through asset protection, and it's in building a portfolio efficiently through tax strategies. And I've written a whole lot on that. I got some articles at Forbes, and we have whole mastery sessions where we've got estate planning and tax strategists and different sessions tackling all different kinds of topics, like on how to use your retirement account in various ways, roll it over to self-directed, doing Roth conversions or backdoor Roths or discounted shares, and a lot of very advanced strategies like opportunity zones. We've done a lot of 1031 exchanges to defer capital gains. And everybody's in a little bit different situation. So, I don't give advice, but, what we talk about is it's more important to think first about an allocation strategy. Make sure you get the right foundational asset protection so it's protected for yourself and your descendants, and make sure that you're structuring it early on in tax efficient vehicles and investing for a balance of tax efficiency, meaning that, like, for example, if you're investing into a real estate deal with cost segregation and large depreciation, you can offset those passive losses most investors can, investing into a medical fund like ours, because those oftentimes passive investors, depending upon their situation, can take income in the medical industry, those passive income in the medical, and offset it by losses in another, passive losses in another. And so those kinds of tax efficiencies allow for you to have stability and non-correlation without being all in one volatile thing, right? And it's important to have some lower risk income things that are not for huge risky growth. And it's important also to look at some things that may help offset your income, but very measured. Like, some people like to really get big in oil and gas.
Yeah.
But turns out some of those ones that are highly risky, where you can lose it all, it's a lot harder to get it back when you've lost it all than it is to just be lower risk. And it's more efficient to be lower risk and measured than to bet big. So you got to be really careful purely betting on things that the government subsidizes. because there's a reason why they're subsidizing those things. They could be higher risk.
Absolutely.
Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live, and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part. No selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you.
And I love the philosophy about, risk. I mean, what's interesting is it's one thing to bet the farm, and obviously that's extremely risky when you bet everything on one thing. But the reality is, like, my philosophy was always never invest more than 10% of, what I've got to any other thing, But what happens is sometimes is you're not thinking of all the risks. You're only thinking of the economic risk. What if the asset collapses or the industry changes or something like that? Well, that's all, most people think of those things. But what about other risks? Like when you own real estate, and you can minimize risk in any industry sector. What if you only invested 10% in something, and then whatever went so drastically wrong that everything else you have is at risk, So you have to really think through the risk in terms of legal risk, financial risk, your time risk, energy risk, all those risks. And it's kind of leading me to another question, sort of going back to the beginning about real estate, is when you were first growing your portfolio and scaling, obviously the big recession changed things for a lot of people. We actually grew. It's just an odd set of circumstances. It wasn't like I had a plan that was recession proof. I just happened to have a model that was the one right model in real estate that was working really well in recession years, But back to your experience, what lessons can you share with people when you were scaling to thousands of apartment units?
Well, I mean, I think I want to say, first of all, that I have had my wins and I've had my losses. And I think that it's better to grow slower and more responsibly and be better allocated and focus on, resilience and non-correlated allocations than it is to grow fast. And that's a little bit of a contrarian perspective because, you have Warren Buffett going around saying, keep all your eggs in one basket and spend your life fighting off that one basket, defending that one basket. But I completely disagree, right? I mean, you can be, through no fault of your own, just doing everything right. But then a pandemic can come along that you can't defend yourself from, right? Or a subprime mortgage collapse. You just made a comment earlier saying, well, make sure that 10% of an allocation doesn't take the rest. And that's why we talk about asset protection. But I myself personally guaranteed a loan and a pre-development that where a developer had a perfect track record of coming in, and I had this, I was going to double and triple my money every few years. And this was a great shoe-in, repeat, rinse and repeat. And back then it was, market's never going to go down, put as much as you can, they're giving away properties. But yeah, so that turned upside down. And unfortunately, being personally guaranteed in a recourse state meant they could come after me for everything, right? So that is a very real thing. And that was an actual case for an investment. The other side is, what happens if you get in a car crash and it's your fault and liability exceeds your insurance? That has happened too. I know people who've had issues with that kind of exposure. But my general sense is I would have grown slower, and I would have worked to diversify better, true diversification, and worked to step out, partner more, and step out into the unknown. Because the problem is everybody gets really comfortable with that one thing they do, whether it's your day job and you've got all your money in your own startups and in your stocks or exit in your own company, or you've done one more thing like real estate. Now you're a real estate guy and an attorney or whatever. And now that's all you do. And then you get way over allocated in that one thing. And you get really excited about that one thing and you grow too quickly, too fast. And then, a downturn happens. So I think the more times I've stepped out, and what I would encourage myself to do when I was younger was stepped out and taken the time to educate and learn about different markets that are fundamentally different drivers. Each time I've done that, I felt better. I felt better and more secure. I've had less of that underlying fear and worry. So I think that's important.
Yeah, I agree. We know it's interesting. When I first started, syndications really weren't all that big of a deal. I mean, but now it's like it's all over the place. So, how do you feel about syndications as an alternative when it comes to both income and risk side? I mean, to me, it seems like it'd be less risky to do it that way. But what's your personal take on syndication? And you're still getting involved with those at all yourself? Haven't done it in the past. Any example or case study would help people see why that might be a better solution for them compared to traditional direct ownership.
I read a bunch of articles. We got in Forbes, you like Patrick Grimes single family versus multifamily, like in asset protection. Patrick Grimes Forbes asset protection. I got a bunch of stuff in there about kind of these and the pros and cons. And I think it's an and both conversation because I think you should own things, but I also think that it's not possible to build a truly resilient portfolio if you are the expert in each of these things. I think you could become an expert in one thing, which I was really good at automation and robotics. And there's a lot of really good doctors, dentists, and CXOs of different things out there, entrepreneurs, and they felt this huge, 10, 20 years being really good in this one thing. And they think like I did, hey, I can also be good in the next thing. Well, it turns out there's somebody else that's been doing that one thing that's going to have the edge on you for 10, 20 years. But even if you figure out the next thing, how are you going to figure out 7 more things? 7 more things. It takes 7 lifetimes or 10 lifetimes to become the expert to build enough competence to appropriately and responsibly invest your own money into that many different kinds of assets. And there's just nobody that has a quality of life that can become the operator, sponsor, the do-it-yourselfer, the DIYer, and that many types of investments that are completely fundamentally different, that are non-correlated to each other, to build true resilience in their portfolio. It requires you to partner. And syndications are a way in which you can partner with other people in other markets and other industries that won't rise and fall together. And there's the good and the bad. I mean, I've been in a lot more deals. I've been in a lot of deals and a lot of partnerships. Enough to know I should have been in a lot less deals and a lot less partnerships. but at the same time, I would have never gotten the spread, the resilience without some losses along the way. If I hadn't stepped out and hadn't trusted and verified but learned to partner along the way.
Yeah, I agree. Partnerships can be tricky. I know in my early years, I finally had one partner and we did really well together, and I would partner with him anytime on anything. His chemistry was there. I was an IT guy. He was an accountant. So we were alike, but different enough that we balanced each other. And the others, it's not like one time I did get clobbered pretty good. The other times it just wasn't. I'm like, all that time and energy. I'm like, come on, I just need to apply myself to, more profitable ventures. But in any case, I know we're going to run short on time here. I knew this was going to happen because there's so much you can talk about, man. You've got a wealth of information. But what I want to do is I want to touch on some of the books here. So you've got Lessons from Thought Leaders, Persistence, Pivots, and Game Changers, and of course, Persuasive Leadership. Is there one book you can think that you might want to give an introduction to for everybody listening? Because if you did this one first, the other books might make more sense or something like that. Is there one that would be a first pick for you?
So if you go to passiveinvestingmastery.com/book, passiveinvestingmastery.com/book, I give it away for free. You can download it or we sign it, send it out to you. And it's the lessons from thought leaders. And I think that's really cool. Why? Because there's, a bunch of really great guys in there. I actually have a copy of it here. You got like Brian Tracy, Dennis Waitley, Bob Berg, Tom Ziegler, Kevin Eastman. Really cool. I'm here next to a Navy SEAL. Way cooler people than me. There's a lot of really neat conversations. Everybody tells some aspect of it, and I tell my whole story. Losing it all, struggles through, being a successful engineer and, challenging way through into alts and coming full time and building passive investing mastery and why I did that, and what we're doing with our investments. So go to passiveinvestingmastery.com/book. You have to put the name of this podcast in there. We get some random opt-ins and we don't send it out, but you can download the book, ebook, or you can request a signed copy, and we'll get it to you. But for me, it's my opportunity to just give back and share my story and so many other people's stories. Is really cool. There's an actual rock star, Phil Collins, lead guitarist of Def Leppard, has a really cool.
That's awesome. Yeah.
It was a really fun collaboration. Do that and then set up a call. Have a conversation, because then wherever you're at, we have some sessions, mastery sessions on different things now. And I've got articles in Forbes and webinars I've done. And I know if I'm not the right guy for whatever you need, I know who to send you to. I know who to put you in contact with. And, I spent a lot of years just trading the baseball cards of these alt investments and strategies with just a few guys. There's nowhere really to go to find all this stuff. And so I'm trying to create like, here's the blue ocean approach. I like everything that I can find and get it out there and get it explained in plain English. And so if anybody interested in our investments or just we can help get you in contact with the right kind of people that you're looking for, let me know.
Yeah. Okay. I appreciate that. What's interesting is I'm pretty sure I met Tom Whitley before. And some of those other, I'm familiar. I love learning. And what's really cool about you just touched on something really important here. For everybody listening, when you put yourself out there and you go to conferences and you read other people's books, there's a much higher likelihood you're going to probably meet them one day, because they're going to tell you in their books, who they hang out with, what books they've read, what training courses they've taken, what conferences they go to, and go to them and shake hands and meet people and just tell them your story, because every single one of us started at the beginning. I wasn't born with a silver spoon in my house. My first house was half of a house. It wasn't a half a duplex. I bought a 4-bedroom, 2-bathroom ranch with my college roommate. Socrates, his dad was a Greek immigrant and showed us how to invest. He never gave us a dime. He taught us how to fish. And that was in my business life, that is the one key pivotal moment in my entire business life. So if you put yourself out there, guys, you're going to meet people like Patrick, okay? And don't be afraid to ask questions. Every single one of us, Lord knows I didn't get where I am by myself. I definitely had help, right? And I paid a lot of it cost me a dime, because I just talked to people. And a lot of it cost me a lot of money. But you know what? I made money on it. I had one mastermind I was in for $30,000. I probably made $3 million off of what I learned in that one mastermind, So in any case, back to you, Patrick. So the website, passiveinvestingmastery.com. That's the primary website. Okay, great. Mm-hmm. So guys, if you're listening, remember, we're going to put this in the show notes. So if you're driving, you don't have to write it down. If you're not driving, please go ahead and write it down, because I want you to go there now and do this. Go to passiveinvestingmastery.com/books, okay, and download the book, Lessons from Thought Leaders. This is how you learn, and learning is how you grow. Remember the formula for success is the right education plus the right information plus the right action equals the right results. That's what it is. Patrick told you here, he wished he would have slowed down at certain points and taken his time and been more patient. Okay, learn from that, because I learned the same lesson myself. There was one point I was doing so many projects, I didn't know what was going on. Contractors were calling me up. Hey, Gary, we open up the wall. We need to do this. We need to do that. And I just kept saying yes all day long. When the smoke cleared months later and all the properties were done, I don't think I made a dime. But you learn the lesson from, it's better to focus on something by itself. Focus on a few things. Do well at a few things, and don't try to be a master of everything. Just start with something that you're comfortable with. Start there and then grow from there. But in any case, we're starting to preach, so I'll wrap this one up. Great show today, Patrick. I really appreciate you doing this, man. Any final wish for everybody? Something that you like, your go-to phrase that keeps you back on track, that kind of thing. You know. Mm-hmm.
Do I have one of those final phrases? You know, I have just 1,000 quotes kind of racing through my head right now. I've said some of them, but I just go find your tribe, I think. And I think the challenge for most people is, like me, wasn't raised with a family that were investing at all. My dad had 3 PhDs. My mom's educator, my sister's educator. None of them had any idea about investing or anything. And so every time I started to venture out, I was pulled back because they loved me and they wanted to protect me. But, it wasn't until, as Gary's saying, get out there and go to those. I say make one passive step a day. Listen to something every day for 10, 15 minutes. I run in the mornings. Listen to something every day from somebody who's like you want to become. Listen to that every day, and you'll start to reprogram your brain, the conversations in your head, and then physically surround yourself, just like Gary's saying, and build that tribe, because they're going to be your friends. Those are going to be your people when things are going great, when things are going not great, and when you need to get over yourself and make a move and get off your ass. Those are going to be the people there for many decades to come. So build that tribe.
Gotcha. Okay, well, I appreciate it. And I appreciate you once again. And everybody listening, I appreciate you. Take care of yourselves. God bless you and your loved ones. And we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.